Here we are finally closing out 2024. As of this video, the Santa Claus rally is real, and personally, I actually think we're about to enter another solid year worth of market returns. But of course, there's going to be volatility all along the way, which I want to prepare you all for to the best that I can by going over some macroeconomics to have on your radar. I am then going to start there and work my way into 6 dividend stocks to add to your watch list that are trading in the red right now, yet poised to perform well over the course of time. And then most importantly, they are all going to continue to divvy out those passive income dividend paychecks. So where exactly then do I want to start? Well, with this Santa Claus rally that we're currently experiencing, whereas the masses of investors are trading more on emotions than tact. Now, I want you to think of investors at the end of the year and the beginning of a new year, kind of like the average Joes, Jims, and Kims out there, who make their New Year's resolutions and then after a month get quite emotional and quit on themselves. We see this exact behavior in the stock market as well, which will likely mean that we're going to see continued rallying into the new year. However, you need to understand our economic backdrop because just weeks ago, Jerome Powell announced an interest rate cut, but then he went on to project that inflation would actually soon notch back up and that the Federal Reserve is actually pushing back all of those rate cut dates. And if all of that actualizes, we are going to be in an economic environment whereas businesses as well as consumers, so all of you, will be more restrictive when it comes to spending more freely, which is where I'm going to go ahead and say, well, we're going to experience more of the same. Now, that means different things for different investors, but if you have, say, a long time, more than 2, 3, 5 years where you can actually be invested in the stock market, I'm just here to say, don't focus on all the noise and continue to double down on high quality investments for the long-term victory. Investing is as simple as that. But if you are now questioning where to look, well, I have 6 dividend stocks that I want to go ahead and put on your watch list, with the very first dividend stock opportunity being Omnicom, ticker symbol OMC, which was formed back in 1986 by a merger of 3 of the largest networks, and now today the firm is actually the world's second largest provider of advertising, marketing, and communication services to well over 5,000 clients in more than 70 countries, thus making Omnicom an advertising powerhouse that is the go-to for many top dog companies. I'm talking like the Nikes, Apples, or Home Depots of the world, which makes it a solid, safe pick for any investor. Now, my hunch is that regardless of the economy that we head into, well, one thing that businesses just can't do away with is advertising, and that means that the stock is going to become more of a buy over time if we get into a dicey economic situation. Most recently, it fell from over $104 per share to $86 per share as of now. That means it's officially down in the red on the year, and the 5-year chart shows that it's actually been appreciating almost 7% amidst plenty of volatility as we experienced. Now scroll down to the income statement that checks out with net income ultimately up by over 5%, and continue to scroll down with me to see a balance sheet where we will find that Omnicom nets over $28 billion in assets to just $23 billion in liabilities. In other words, we're talking about a healthy company, and that leads us now to the dividend. So jumping into Simply Safe Dividends, a safety score of a 70, we get a dividend yield coming in at 3.24%. Scroll down with me, a lower payout ratio at 36%, 38 years worth of a track record. All sounds great, but check this out, a 10% average annual dividend growth rate over the past 20 years. But if advertising in that industry is just a little too volatile for you, I want you to look into trash. Yeah, you heard that right. Trash, as in garbage collection, with Waste Management, ticker symbol WM, which is actually becoming more and more of a stock on focus for me on the hot list to buy in the upcoming year. Been one of Bill Gates' top positions as well. It's a standout company for the sake of trash collection being an absolute necessity for all of us. Now, better yet is just the fact that there are really only 2 major waste management companies that are contracted with a plethora of municipalities across the United States, and this is one of them. So you have plenty of safety and reliability with Waste Management, but moreover, as the company really just looks to go even greener in this industry and into the future, this is the beginning of something worth your attention now. Clicking into their stock chart, we can see that Waste Management recently slid from the highs of nearly $230 per share to just $205 per share. So it has my attention, as I said, and on that 5-year chart, we're going to see a company that soared over 80%. Now scrolling down, we see plenty of revenue flowing in and year out, while the balance sheet exudes health as well, with assets up right now by about 5%, totaling over $32 billion, with liabilities just at $25 billion. Now, if we get into the dividend metrics, we're going to find that Waste Management comes in scoring an 80, with a lower dividend yield at 1.61%, but I think you're all in this for the growth, or at least I would be with Waste Management. Scrolling down, we get a payout ratio at 41%, 24 years worth of a dividend streak, and here we go with that dividend growth rate coming in at 33%. But if you are more interested in, say, a comeback type of play or investment that will certainly deliver some serious bang for your buck, I want you to get your eyes right now on Canadian National Rail, ticker symbol CNI, which is a rail and logistics kingpin that was established back in 1919 and now operates an extensive rail network spanning about 20,000 miles across Canada and well into the United States. Now, with President-elect Trump already talking tariffs and even adding another state, honestly, that puts this company really in a bind. Now, otherwise, it's creating an opportunity for us. So let's click into the stock chart. We see that Canadian National Rail is currently down by 17% on the year, trading for $102 per share. However, click into that 5-year view, we're ultimately going to see it is in the green, up by over 13%. And more importantly, scrolling down, Canadian National Rail is a healthy company with net income having increased by almost 10%. And that's even recently an uber clean balance sheet as well, with assets increasing to $52 billion, whereas liabilities are coming in around $32 billion. Now, jump right into Simply Safe Dividends with me, and we're going to find that it has one heck of a safety score coming in at 97 with a dividend yield at 2.38%. All of that payout ratio sits at a low of 46% after 27 years worth of a dividend streak, and moreover, a gift of a dividend growth rate here as well, averaging 16% as we speak. That is not too shabby. Investors, that means we have 3 down now and 3 more to go, but here's the biggest request I have for you to end 2024. Help me hit my goal of getting this 55% of you watching and tuning in video to video but not actually subscribed down to at least 50%. 2025 is gonna be our year, my word, as we execute together. And while you're at it, let me know that this is the content that you want more of just by tapping on that thumbs up button, and of course I'll keep creating more lists like this. With that, we're going to get back to it with Robert Half, ticker symbol RHI, which is not exactly your traditional recruiting service, as it's actually in the business of being the world's largest of its kind. Now, with recruiting services, you have to realize that their business model depends on our economy and what businesses are doing or in need of. Are they hiring? And even if they aren't on a large scale, they will look to actually tap into top talent, just like Robert Half always has been doing. And moreover, given I'm optimistic about our economy, I do foresee an uptick in companies actually expanding, which means that I like the stock as it is right now, trading down now over 17% on the year. But clicking out to the 5-year view, we are going to see a company that has plenty of greenery there, coming in with over 14% worth of share price appreciation. Now scroll down with me here, because of course we're going to see revenue that has just been impacted, which is expected in the economy that we're currently surviving in. But what matters most is that balance sheet to withstand it all, to which we're going to discover total assets are notching up to over $3 billion at this point in time, whereas liabilities are just at $1.4 billion. Jumping into Simply Safe Dividends, we do see a nice safety score coming in at an 80, along with a 2.97% dividend yield. Scrolling down, a red flag here with the payout ratio at 76%, but it has nonetheless been on a 19-year dividend streak while averaging a solid dividend growth rate of 12%. Now, as for these last 2 dividend stocks, these are the buy and forget type of investments. I'm going to go ahead and break down Caterpillar first, ticker symbol CAT, which is the world's largest construction engine and machinery manufacturer, which is a reason enough to literally just at least always have your eyes on Caterpillar or have this one on your watch list as a dividend investor. But here's what I'm thinking when it comes to Caterpillar these days. Under Trump, we may get an administration fixated on building for legacy purposes, but then economically speaking, perhaps we won't be getting that build up, and we're actually just going to get more of the same, which means Caterpillar would come down even lower, thus creating an even better buying opportunity for all of us. So just have your eyes on Caterpillar. As we can see right now, it is actually on the way down, though still up overall in the year by 25%. And on that 5-year view, we're going to see Caterpillar is up actually over 147%. Therefore, it pays to actually be invested in building the future of our nation's infrastructure. Now, come down to discover a sound income statement with plenty of revenue flowing in constantly, as net income rose by over 54%. As for the balance sheet, equally as clean, coming coming in at 87 billion in assets, just 67 billion in liabilities. But here's what matters most, the dividend metrics. So let's jump into Simply Safe Dividends. We're going to discover a 93 on that safety score, along with a smaller dividend yield to go along with it at 1.53%. But that gives us safety for the longer term. Payout ratio now at 25% after 31 years of a dividend streak. And to top it all off, we have an average dividend growth rate coming in at 10%. And then finally, a stock that is currently in my portfolio in a position that I would really like to scale up like crazy in the upcoming year. We have Lockheed Martin, ticker symbol LMT, which is Uncle Sam's go-to when it comes to military contracts and defense spending. Now, something just to note when it comes to Lockheed Martin is the fact that it is the largest defense contractor in the world. And with the world as it is right now, well, it doesn't look like Lockheed Martin is going to be going short of revenue anytime soon. And should matters only escalate in the coming years, which I'm actually highly doubtful they will, as we're already seeing some cooling tensions geopolitically speaking, Lockheed will be there to deliver for us all, dividend by dividend. But as mentioned, because of the cooling tensions globally, when it comes to war fronts, whether that's in the Middle East or Ukraine and Russia, Lockheed has actually faltered and looking like an opportunity right now as it trades for $488 per share, down from $600 back in October. Now on the 5-year chart, it is actually up over 24% still, and scrolling down, you're going to get a taste of that revenue flowing in, along with an exceptionally clean balance sheet, $52 billion in assets to just $45 billion in liabilities. But I have been and will remain invested in Lockheed Martin, all because of the dividends and long-term durability. So have a look here at Simply Safe Dividends. We got an 84 safety score, Lockheed's 2.7% dividend yield to capitalize on, scrolling down at 45% payout ratio. Quite a dividend streak here of 31 years of that track record, all while maintaining an average dividend growth rate right now of 16%. There you have them, all 6 dividend stocks to have your eyes on. Comment down below to let me know which ones actually caught your attention the most, or if you just have better dividend stocks in mind. Be sure to tune in right here to catch my latest Masters of the Market chat. You're not going to want to miss out on that. Subscribe, and of course, I will catch you all in the next one.